Tonight, we're diving into a powerful signal that's quietly shaping the decisions of some of the world's smartest investors. Whether you're a seasoned market watcher or just starting to explore the world of finance, understanding this tool can help you make sense of big market moves and spot opportunities before they hit the headlines. It's called the Uranium to S&P 500 ratio, a simple yet revealing metric that compares the performance of uranium stocks to the broader U.S. stock market. This ratio lets us see, at a glance, how companies involved in mining and processing uranium, the essential fuel for nuclear power plants, are stacking up against the giants of American industry that make up the S&P 500. It's a way to cut through the noise and focus on where the real momentum is building in the market. By tracking this ratio, investors can quickly spot which group is outperforming at any given time, helping them decide where to allocate their capital for the best potential returns. When the ratio is on the rise, it means uranium stocks are attracting more investment than the broader market. This often signals growing optimism about the future of nuclear energy, as more money flows into companies poised to benefit from a global energy transition. On the other hand, when the ratio falls, it suggests that investors are seeking the relative safety and stability of large established companies, perhaps due to uncertainty or risk aversion in the market. But this ratio is more than just a performance tracker. It's a macro indicator, a window into the flow of capital across entire sectors, revealing shifts in investor sentiment and the broader economic landscape. For much of the past decade, tech and consumer stocks have dominated the headlines and investor portfolios, leaving commodities like uranium overlooked and undervalued. This has created a unique setup for those paying attention. A major move in this ratio could be the first sign of a dramatic shift in market leadership, potentially marking the beginning of a new commodity supercycle, where resources like uranium take center stage. In this video, we'll unpack the story behind this ratio, its dramatic fall during past cycles, its long period of hibernation, and the technical signals that suggest a new chapter may be unfolding right now. We'll also break down the fundamental reasons driving this potential shift, from tightening supply and growing demand, to new government policies supporting nuclear energy and the global push for cleaner power sources. By understanding this ratio, you'll gain a unique perspective on the evolving landscape of global energy and investment, and be better equipped to spot the next big opportunity as it emerges. To truly understand the state of today's uranium market, we need to revisit a pivotal moment in recent history: the 2011 Fukushima disaster. This event sent shockwaves through the global energy landscape, and its effects are still felt today. The massive earthquake and tsunami that struck Japan triggered a nuclear crisis at Fukushima, turning public sentiment sharply against nuclear power, not just in Japan, but around the world. Overnight, nuclear energy went from being seen as a reliable low-carbon power source to a symbol of risk and uncertainty. In response, Japan shut down all of its nuclear reactors, causing a sudden and dramatic collapse in uranium demand. This led to a massive oversupply, as uranium producers found themselves with nowhere to send their product. Uranium stocks plummeted almost immediately, while the broader market, represented by the S&P 500, began a new bull run. Uranium investors watched as the uranium S&P ratio entered a relentless, multi-year decline. For 5 long years, uranium stocks dramatically underperformed. Prices kept falling, mines were forced to close, and investors abandoned the sector in droves, seeking safer opportunities elsewhere. Many mining companies lost over 90% of their value, with some teetering on the brink of bankruptcy. Meanwhile, Wall Street thrived, and the S&P 500 soared to new heights, highlighting the stark contrast between uranium and the rest of the market. The narrative shifted dramatically. Uranium was now seen as toxic, both literally and figuratively. Renewables like solar and wind took center stage, capturing the imagination of investors and policymakers alike. This negative sentiment became deeply entrenched, making it nearly impossible for the uranium sector to attract new capital or even maintain existing investment. The industry was left in the cold, with little hope for a quick recovery. The long winter for uranium had truly set in. For many, it seemed like this period of stagnation and decline would never end, as the sector was frozen in time, waiting for a thaw that seemed out of reach. Yet, beneath the surface, the seeds of a turnaround were quietly being sown. While the world looked away, forces were gathering that would eventually set the stage for uranium's next chapter. After the Fukushima disaster, uranium's collapse seemed endless, but between 2016 and 2020, the pace of decline finally began to slow. The sector was battered, but the worst of the panic selling had passed. The uranium market wasn't recovering yet, but the relentless wave of selling that had defined the previous years was fading. Investors, worn out by years of losses, had largely given up, and exhaustion set in across the sector. Most of the sellers had already exited, leaving behind only the most patient long-term believers, and a handful of value investors who saw opportunity in the ashes. With so few willing to sell at these depressed prices, a floor began to form under uranium stocks, providing a sense of stability that had been missing for years. On the technical charts, a double bottom pattern started to emerge, a classic sign that a major reversal could be on the horizon, hinting at a shift in sentiment. The uranium to equities ratio hit a significant low in 2019, bounced, and then retested that low in 2020. Importantly, it didn't break down further, suggesting that sellers were finally exhausted. This stabilization signaled that downward momentum had run its course, and a solid base was quietly forming beneath the market. For the few analysts still paying attention, this was the first real glimmer of hope in nearly a decade, a subtle but important shift in the market's mood. The completion of this bottoming pattern marked a critical turning point. It was a signal that the worst might finally be over, and that a new phase could be beginning. Years of relentless price declines had forced high-cost mines to close their doors and discouraged any new production from coming online, tightening future supply. With sellers gone and supply shrinking, the stage was set for buyers to cautiously re-enter the market, sensing that the risk-reward balance was finally shifting in their favor. Quietly, almost unnoticed, the uranium market was preparing for a comeback, one that would catch many by surprise in the years to come. In 2021, the uranium to S&P 500 ratio broke above the neckline of its double bottom, a strong bullish signal. This breakout was fueled by the launch of the Sprott Physical Uranium Trust, which began buying and holding physical uranium, tightening supply. Utilities, seeing the market tighten, returned to sign long-term contracts, providing steady demand. The ratio didn't skyrocket but entered a long consolidation, trading sideways from 2021 through early 2025. Technical analysts saw this as institutional accumulation, big investors quietly building positions. Selling from short-term traders was absorbed, and a strong base was built for the next move. The uranium market was no longer in freefall. It was coiling for something bigger. The stage was set for a potential breakout. All eyes turned to a critical resistance level. By late 2025, uranium is at a pivotal moment. After 4 years of consolidation, the uranium S&P ratio has broken out of its trading range and is now testing a 9-year resistance level. This trendline has capped every rally since 2016. A decisive break above it would confirm a massive multi-year base and signal a major capital rotation. Such a breakout could attract a flood of new capital from traders and institutions, transforming the rally into a multi-year bull market. The risk-reward profile is highly asymmetric. Strong support below, significant upside above. Technical targets suggest the potential for multi-fold gains. For investors, this is a rare setup where the odds are stacked in their favor. The uranium market is on the verge of a new era. The next move could be explosive. The uranium market is now facing a severe supply crunch. Major producers like Kazatomprom and Cameco have cut production due to operational challenges. Restarting mines isn't easy. Delays and shortages are common. Secondary supplies like government stockpiles and downblended warheads are nearly gone. Geopolitical risks are rising. Instability in Niger and a U.S. ban on Russian uranium have tightened Western supply. Utilities in the U.S. and Europe now compete for a shrinking pool of uranium from allies like Canada and Australia. The supply buffer is gone, and new sources are slow to come online. This tightening supply is putting upward pressure on prices. The era of cheap, abundant uranium is over. At the same time, demand for uranium is surging. Over 70 new reactors are under construction worldwide, especially in China, India, and South Korea. Countries are extending reactor lifespans and restarting old plants. Japan has already brought more than a dozen back online. Government policies are now pro-nuclear. The US offers tax credits, and the EU has labeled nuclear as green, unlocking ESG investment. New technologies like small modular reactors promise even more future demand. The nuclear renaissance is real, and uranium is at its center. The market is waking up to this new reality. Despite the bullish outlook, uranium investing is risky. The sector is volatile. Prices can swing wildly on news or sentiment. A failed breakout at resistance could mean more sideways action. Policy risk is real. A nuclear accident or political shift could reverse pro-nuclear momentum overnight. If uranium prices rise too far, too fast, new supply could eventually flood the market. Mining stocks face operational, regulatory, and environmental risks. Even if uranium prices rise, not every company will succeed. Due diligence is essential. Don't concentrate too heavily in one stock. Be prepared for volatility and setbacks, even in a bull market. The rewards can be great, but so are the risks. Caution and research are your best allies. The uranium to S&P 500 ratio tells a story of dramatic turnaround. After a decade in the wilderness, uranium is challenging a critical resistance level, signaling a possible new bull cycle. Supply is tight, demand is surging, and the technical setup is bullish. Nations worldwide are embracing nuclear power for energy security and climate goals. New reactors, plant extensions, and advanced technologies are driving long-term demand. Risks remain, but the evidence points to a new era for uranium. For investors, the long winter may finally be over. A new dawn is breaking for this critical energy commodity.